Most people build their investment portfolio before making the one decision that has the biggest impact on how much of the return they actually keep. And that decision is not which fund to pick, it is where you hold it. The mistake is sequence. Most people decide what to invest in first, which fund, which platform, which shares, and they spend hours researching returns and fees. Then, almost as an afterthought, they pick an account to put it in, often a general investment account or whatever the platform defaults to. And that sequence is backwards. The account wrapper, where you hold the investment, has a larger impact on your long-term net return than almost any fund selection decision you'll ever make. And it takes about 5 minutes to get it right. An investment portfolio is simply the collection of assets you own: funds, shares, bonds, property, held together with a purpose. And that purpose is what most people skip when they start. A portfolio without a clear goal is just a list of things you bought. The structure, the allocation, the account, the time horizon is what makes it a portfolio. Before picking a single investment, 4 questions determine whether the portfolio you will build will actually work for your situation. First, what is this money for? Retirement, a property deposit, financial independence, your children's future. The goal determines everything that follows: the account type, the risk level, the time horizon. Second, how long can you live it? Under 5 years, the evidence points toward low risk assets or cash, and above 5 years, growth assets become the appropriate tool. Third, how much volatility can you tolerate? Not in theory, in practice. If your portfolio dropped 20% in value overnight, what would you do? And if the answer is sell everything, your allocation is too aggressive for your risk tolerance. Fourth, have you used your tax allowances first? This is the question that most people leave until last, and it should be the first structural decision you make. Asset allocation is simply how you divide your money across different types of investments. It is the most important decision in portfolio construction. It determines the majority of your long-term returns and most of your short-term volatility. And there is no single correct allocation. There are 3 broad profiles based on your time horizon and risk tolerance. If you need the money within a few years, or if significant drops in value would cause concern, a more defensive portfolio weighted toward bonds and low-risk assets is the appropriate starting point. If you have a medium time horizon and some tolerance for short-term volatility, a balance split between equities and bonds gives you growth potential with some cushion. If you have 5 or more years and can stay invested through market downturns, a growth allocation weighted heavily toward equities is where long-term compounding happens. Diversification is one of the most misunderstood concepts in personal investing. Most people think it means holding multiple funds. It doesn't. It means holding assets that actually move differently from each other. The most common mistake I see is holding 4 or 5 funds that are all primarily invested in the same large US technology companies. And it creates the appearance of diversification without the reality of it. When those stocks fall, they all fall together. Real diversification means spreading across asset classes, geographic regions, and sectors, so that when one area of the market drops, another is cushioning the impact. Before you put a single pound into an investment, there is a structural decision to make, and it is the one with the most long-term impact on what you actually keep. The ISA, individual savings account, is the most tax-efficient investment wrapper available to UK investors. The annual allowance is $20,000 for 2025-26 tax year. Any growth, income, or gains generated inside the wrapper are completely free from income tax, capital gain tax, and dividend tax. You don't have to report it to HMRC, and it doesn't appear on your tax return. Outside of an ISA, the same returns could be subject to multiple layers of tax depending on your personal circumstances. Inside it, none of that applies. The ISA is not a product, it's a container, and the investments you hold inside it can be exactly the same as funds, shares, or bonds you would hold anyway, and the difference is purely the tax treatment. The AISA benefit is not abstract, it is measurable. Take 10,000 invested at a 6% annual return, the same investment in two different places. Inside the stocks and shares AISA, after 30 years, that 10,000 becomes approximately 57,400, and every pound of growth stays invested. No tax drag, no annual reduction in the compounding base. Outside an AISA, subject to a simplified tax drag for a basic rate taxpayer, the same investment over the same period produces roughly 40,400, and the investment itself is identical. The difference is purely the tax wrapper. That gap, over 17,000 on a single 10,000 starting position, is what the AISA allowance is protecting. Building a portfolio is not just about finding the best fund. It is about making the right structural decision first. Your goal, your time horizon, your risk tolerance, and the wrapper that protects what you earn. Get those four things right before you pick a single investment, and the portfolio largely builds itself. Next, I'm going to show you how institutional investors and private equity funds think about portfolio construction at a completely different scale. The principles are the same, the sophistication is not. Subscribe so you don't miss that one. See you next time.